Very few financial writers have had the impact Charlie Ellis has had. His 1975 book, Winning the Loser's Game, popularized passive or index investing 50 years ago. Charlie Ellis joins us now along with ETF expert and financial futurist Dave Noddick. Charlie, thanks for being with us. You've got a new book out this week, Rethinking Investing. I read it. It summarizes your investing philosophy. You've been a champion of index investing and staying with the markets, not trying to beat the markets for 50 years. Here's a copy of the book we're showing right here. You were a very early champion of ETFs. This show is about ETFs, so let me start with that. What do you like about what you see in the ETF world right now, and is there anything that worries you about ETFs?
Sure. What you've got to be really positive about is a terrific increase in the variety of ETFs that are available and a reduction, steady reduction in the fees that are being charged. That's all good news. What you've got to be worried about is some of the ETFs that are being produced are much more for the salesperson than for the buyer. And they're too specialized, too narrow, or the ones that really bother me are the ones that are highly leveraged so that you get explosive on the upside, but also explosive on the downside. So you've got to be careful. ETFs are an absolutely wonderful device. Very, very effective. I use them, and everybody I know who's really with it with regard to investing uses ETFs, but you've got to be careful enough to use the ones that are appropriate for who you are and what you're trying to accomplish.
Yeah, good point there. I want people to understand your place in history here. You, along with, I guess, Burton Malkiel, who wrote A Random Walk Down Wall Street, and the Vanguard's founder, Jack Bogle, three of you were sort of the intellectual architects of index investing. 50 years ago, you were talking about this. That approach, indexing, has clearly won out. But now we see the active investing community sort of reacting, some of them claiming passive ownership or indexing is approaching dangerous levels. Is there any truth to that? Does that concern you at all, or is that just sour grapes by active management?
I think it's sour grapes primarily. It certainly doesn't bother me at all. When people talk about peak passive and other ways of describing, there are too damn many people going into passive investing, so it's got to be really wrong. They forget that the only thing that really matters is if you drive the really good active investors out of the business, then maybe you've got a problem, because passive has got to be dependent on active managers who are really good. But candidly, the number of people that get hired into active management keeps rising, and we're way, way overloaded with talent in that area. And we're going to stay there as long as it's great fun, high paid, and you might also make a small fortune on your own account while you're in there actively doing something for other investors. So this nonsense about peak passive, this is candidly just nowhere near on the money. The real problem will only be when people stop being active managers. And that's a long, long, long way off.
Dave, you've written a lot about this. Peak passive, there's still plenty of active managers
I think there's still plenty of active managers around. I understand Charlie's point here. I do think that there are places in the ecosystem where the prevalence of passive flow really does have an impact. If you look at things like just derivatives trading, you look at the amount of money indexed against the same 500 securities all around the world, in swaps, derivatives, futures, you name it, that does have impacts mostly on the plumbing of how markets work day to day. And let's remember also that almost all the new money coming into the market is coming into passive funds. And because of that, there is the sense that we're constantly bidding up the same securities in the same proportions. That leads to momentum effects. Yeah. Do I think it's destroyed price discovery? Absolutely not. You can look at any given day and see the enormous divergence between the best and worst performing stock in the S&P 500 to realize that price discovery is still happening.
Yeah. So the argument here is, I'm paraphrasing the ETF haters, the argument is passive investing essentially has been driving up growth stocks, and it's shrinking the pool of price-conscious investors out there. And value investors bitterly complain that they don't have enough firepower anymore. But is there any merit to any of these arguments?
There is some truth to that, but also it has to be put. Go ahead, Charlie.
I would say there is a little bit of merit to each of the different points that's been made. But if anybody tried to measure it, and you know darn well that every PhD candidate across the world is trying to find a way to outsmart the idea of passive or indexing. And the same thing is true with ETFs. They're searching and searching and searching for something that they could report, because if you're a PhD candidate, that would be gangbusters. They're not able to find it. We can talk about it must be there, and I will agree that it must be there, but the magnitude is so darn small that nobody's been able to measure it and say, Eureka, I've found it. Look, here it is. It's not there.
Yeah.
I certainly don't think that there's any evidence that we're all of a sudden going to end up in a world where people are beating the market on the regular, right? I mean, I think the math here, which, hey, I learned from reading Charlie's books, right? The math here is inexorable, that it's really impossible to beat the market consistently. I mean, Charlie in his own book, in the recent book, points out that, hey, active management outperformance is possible. You'll just never find it in advance, and that's the problem.
Yeah. So the corollary is passive inflows continue. Equity valuations might continue to climb sharply because it's just...
Sure, but
as you point out, there's no evidence
we
that...
We also just had the best year for active management inflows in the ETF market we've ever had.
Yeah.
So it's not that nobody thinks active management should exist or it should exist in the ETF wrapper. It's just the vast majority of new flows because they're coming in from fairly unsophisticated individual investors go into big indexes and big target date funds.
Charlie, I want to get back to the fundamentals here for people who aren't familiar with your history here. Your new book emphasizes the keys to long-term investing success, and they are saving, first off, the power of compounding interest, and using index funds and ETFs to minimize fees. This is sort of like Charlie 101 here, and you've devoted decades to studying this whole thing, active versus passive or index investing, whatever you want to call it. One of the things that you will bring up regularly is S&P's annual SPIVA study, which shows over 10 years, 90% of large cap fund managers underperform the S&P 500, 90%. So can you just, for people who aren't familiar with your work, because your work is seminal in understanding this, summarize why active managers almost invariably underperform their benchmarks for us?
Well, the ironic but true answer is they're all so damn good at what they're trying to do that they cancel each other out. They all have fabulous computing power. They all have access to Mike Bloomberg's terminals. They all have terrific models, quantitative models that they can follow. They have access to the most extraordinary amounts of research information available worldwide, and they've got terrific striving focus as individuals. They're really terrific people. They are very good at what they do. The only problem is everybody else knows exactly what they know as soon as they know it, and everybody else is smart as the dickens, and they're all competing. And it's a little bit like playing poker with all the cards face up on the table and then betting for real money. It's really hard. And the problem they have is there are some modest costs of execution and operation, and that's what's showing up.
Right. So the point is, this isn't because, Charlie's point is not because active managers are stupid or dumb, it's just the opposite.
Right.
Most are now professionals and they're really smart, but they're all just competing against each other. It's a simple insight, but it's very profound.
And Charlie's got a great section in the new book on this where he talks about how technology, far from being a competitive advantage for this firm or that firm, has actually been this unbelievable equalizer across active managers. So where once you might have had a better model, a faster computer, a better connection to the market, now everybody's got that. So if everybody's got all the information, to Charlie's point, getting an edge is extremely difficult.
Right.
And the idea you as an individual investor are going to get access to that manager with that edge, vanishingly small.
And so why is active management still so prevalent?
Give me just a minute to say
Go ahead.
That's very helpful. You know, at my advanced age, I'm 87. So what the hell am I doing paying attention to investment management these days? Because I was around in the 60s. Then in the 60s, you could call any corporate executive and say, I've done my homework. I'd like to come and meet with you. They usually invite you to stay for lunch. Then you get an hour of in-depth information from the corporate executive, trying to be sure that their stock price was fair or as high as it should be, as the best protection they had against corporate raiders. Today, that kind of a conversation is against the law. Nobody does that anymore.
Yeah.
It's illegal.
Reg FD.
Yeah, and you know, arguably should be, but it is a leveling of the playing field that makes outperformance incredibly difficult.
Yeah. So the question people ask me all the time is, well, all right, if they always underperform, why do so many still use active managers? And you have what I guess you would call it a recency bias. Those who outperform get the publicity. The financial press does this. We highlight whoever the hot active manager is and make them stars.
Yeah, we're always chasing the hot dot. But again, another great part on behavioral finance in his book, Charlie talks about the fact that, look, everybody thinks they're above average, right? Everybody thinks they're in the top 1%, and therefore they'll be the one that will be able to pick that active manager who will outperform. It's very hard to convince people that they have to accept the average.